Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Lead Partner. Welcome to our April 2016 IFRS Insurance Webcast. Today's webcast is titled New Conditions for the IFRS 9 Deferral. A revised criterion is approved for the all or nothing deferral approach on IFRS 9. As it is a tradition in this webcast, which has been running since July 2009, we have an agenda around 3 items. The first one is the highlights of the ISB meeting on the IFRS 9 decoupling problem. They came out from the meeting on the 19th of April, last week. We then dive deeper into the topics discussed in that meeting, understand the analysis that the staff produced in their relevant papers, the discussion that followed, and the tentative decisions that the ISB reached. And then a few minutes at the end to talk about the next steps, primarily around the IFRS 9 decoupling. The IFRS 4 phase 2 is still in the balloting phase, and at this stage the ISB staff and the board members are busy reviewing the first draft of the standard. The highlights, it's a page load. It's a lot of stuff actually that occurred last week. This is a project that really is keeping the board busy. The first decision was a confirmation that most of the proposals in the exposure draft on the overlay approach were actually retained. The second is a clarification that qualifying financial assets could include also surplus assets and financial assets held by one legal entity as relating to contracts within the scope of IFRS 4 that are issued by a different legal entity within the same reporting entity. Third decision is to present the overlay adjustments in one way only. No more freedom as proposed in the exposure draft, only one way, and that is a single line item in P&L and the OCI, with a breakdown in the footnotes. Then we have a few decisions on the deferral approach. First, there is a new test for the predominance of insurance activities. This will include liabilities related to insurance plus other connected liabilities in the numerator, but the denominator will remain the same as it was in the exposure draft. In terms of the threshold, has been now elevated, is higher, and moved up from 75% to a 90% safe harbor level, with a zone between 80 and 90% where additional demonstration of predominance has to be granted by effectively observing what is included in the remaining 20% maximum of liabilities in terms of other activities that may still be significant. If that is the case, then the test will result in a negative outcome and no deferral will be available. But if no significant unrelated activities exist in the remaining 20%, you pass. They also have agreed that this ratio will be computed in the year ending within the 12 months period that ended on the 31st of March 2016. So any year end within those 12 months period will be the reference point. There's going to be a reference point in the past. And finally, disclosures for the deferral approach have been amended to cover the new qualifying criteria. In addition, there will be a new requirement to introduce in the consolidated financial statements subsidiary disclosure. If any of the subsidiaries consolidated in that set of consolidated financial statements produces IFRS 9 information, that information will have to be noted in the footnotes of the group accounts. It's quite a lot of discussion and decisions. Let's begin with the overlay approach. The analysis of the staff here started by noting the observation from the comment letter around the inconsistency that may arise from the designation of financial assets relating to contracts within the scope of IFRS 4. And what the analysis highlighted is that there could be a need for clarifications with regards to qualifying financial assets that are held to cover for the surplus of an insurance company, when that surplus is representative of the solvency capital, for example, or the internal capital measure that the entity uses to run its business. Financial asset that an entity holds in that regard may still deserve to be qualified assets as far as the designation for the generation of the overlay adjustments, not just those that are strictly speaking backing insurance liabilities. The other guidance into the clarification space of the overlay approach from a qualifying assets perspective included the fact that some comment letters indicated the difficulty to include assets that are held in respect of activities other than those associated with contracts within the scope of IFRS 4. The staff noted that they do not believe it is feasible to provide more specific guidance on identifying assets that specifically relate to insurance contracts. And so it looks like that these examples will be the maximum extent of improvement that the staff concluded from its analysis. So coming to the recommendation, which essentially confirm to a significant extent the exposure draft proposals for qualifying assets, we have a financial asset will be qualifying for the overlay approach if it is designated as relating to contracts within the scope of IFRS 4 and it is measured at fair value through profit and loss under IFRS 9, but it will not have been measured at fair value through P&L under IAS 39. So that is the key condition that depends on the comparison between the two accounting requirements. And then the second condition is the relationship with the insurance contracts. An entity that will apply the overlay approach may designate as an asset even if it was acquired previously if the conditions that I described earlier are met. It could also decide to de-designate previously recognized financial assets in terms of the generation of overlay adjustments, and it will be required to do so when the condition that connects that asset with the IFRS 4 contracts ceases to exist. And when that happens, the exposure draft proposal has been confirmed. You will have to reclassify and recycle through P&L the accumulated OCI balance that was previously accounted for in accumulated other comprehensive income reserve. The staff also recommended that the board clarifies that qualifying assets could include surplus financial assets held for regulatory credit rating and internal capital reporting purposes, and also that the disclosure of the basis for designating the financial assets held by one legal entity as relating to contracts issued by another legal entity within the same group should be permitted and reported. When the debate started on this large number of recommendations, most of which were confirming this procedure draft, in fairness, several board members actually expressed reservations about this idea of designation of assets which are in a legal entity that doesn't effectively issue insurance contracts, and they are related to an insurance contract issued by another legal entity within the same group. This is actually a fairly common situation, and the staff effectively convinced the board, subject to some wording that I explain in a second. But the key point here is that if you have a life insurance subsidiary, and that life insurance subsidiary is part of a group where certain assets are held within a mutual fund, and that mutual fund is wholly owned by the subsidiaries of the group because it sells units only to life insurance subsidiaries, for example, to back unit-linked insurance contracts. Then the two entities are not the same. There is one legal entity that has got the assets, which will remain in the consolidated financial statements, and those financial assets in the mutual fund will be related to the insurance contracts issued by the life insurance subsidiary. The units in between are eliminated in consolidation. And so that is a typical situation where legal entities are different, but there is a relationship between the assets and the insurance contracts. And the board effectively was persuaded by all this discussion and agreed just in a small wording change where the word group was replaced by the word reporting entity. So the recommendation was just amended to say issued by a different legal entity within the same reporting entity. Other than that, everything else was confirmed, and the vote was 12 board members in favor and 1 against. I will mention this only once, but throughout this whole meeting, 1 board member was absent, and so the tally of the votes is always 13, but there are still 14 board members in place at the moment at the IASB. Then we move into the presentation of the overlay adjustment, and the analysis here from the staff highlighted a few things. The first one is that comment letters highlighted that information, if it is broken down by many different line items in some instances and presented on a single line items in other instances as permitted by the exposure draft, it's almost unavoidable to have a very difficult to compare set of financial statements. That is compounded by the fact that you can then with difficulty compare those entities that have not used the overlay approach with the ones that have used the overlay approach in their financial statements. Second point is that entities that apply the overlay approach could present mixed information. Some may actually blend in a single line item reflecting impairment losses in accordance with IFRS 9 to impairment losses in accordance with IAS 39, and you will not be able to see them separate until you go to the footnotes perhaps. So the staff analysis indicated that a single separate line item that provides all the accumulated adjustments that the overlay approach is designed to deliver would be probably the most useful way of presenting that approach. And it would also result in the same IFRS requirements being visible in the financial statements for all entities, those with and those without the application of the overlay approach. The recommendation that the staff put forward, that I'll explain in a second, will effectively result in the breakdown by line into the disclosure footnotes, where this information will still be presented, but without undermining the comparability of the primary statements. And so, coming to the recommendation, the first one is to amend the proposals on the presentation and require an entity to present in P&L the information that reflects the application of IFRS 9 with a single separate line item for the overlay adjustment. And in OCI, you see the overlay adjustment with the equal amount and opposite sign to effectively demonstrate the full elimination at the bottom of the statement of comprehensive income. And the second amendment is to disclose the effect of the overlay approach on individual line items in the footnotes to the financial statements. In addition, the staff recommended to confirm the following proposals without further amendments: the initial application of and ceasing to apply the overlay approach, the application of the overlay adjustments to pre-tax profit or loss, and the transition to the overlay approach. I'm not going to explain these three areas in any further detail, but I'm happy to take questions from participants if you have any later on. The discussion was very limited on these issues, and the tentative decision was again 12 board members in favor of the staff recommendation and 1 against. Then the staff took the board the papers related to the deferral approach, or temporary exemption from IFRS 9 as they call it in their papers. The analysis here focused on the predominance criterion, and I have to tell you, I'm going to have a few pages about that, because I think that of all the things that were discussed last week, this is perhaps the most important topic. So I want to make sure that you fully appreciate the thinking process that the ISB staff and board members have been through before reaching their decisions. So the staff paper analysis started by observing that some respondents thought that the predominance criterion in this project draft should be principle-based, and that means either qualitative or a combination of qualitative and quantitative criteria. Others, like Deloitte, were actually more supportive of a quantitative assessment because it would give a clearer and unambiguous view that can be applied by all entities consistently. And the staff observed that they would share that perspective. Then the analysis also noted that the predominance criterion should be anchored to quantitative factors because that could provide some objective assessment that could be more clearly described, understood, and applied across the many jurisdictions that are now applying IFRS. And finally, the analysis concluded that, in the opinion of the staff, there isn't really any single qualitative factor that could be able to achieve this objective of clarity and consistency of application in isolation. like the criteria suggested by some letters of using the status of an insurer being regulated as such criteria. The staff paper observed that there are concerns that the proposed predominance ratio, as it was drafted in December, would actually result in some entities which are normally considered to be stakeholders by the market, so pure insurers by the market, would not qualify for the exemption. That would not be an intuitive outcome, so the staff is conscious of trying to avoid that outcome. In describing the predominance by reference to income and expenses rather than balance sheet, the staff concluded would still derive the same concerns, the same issues, and so they have decided not to follow the statement of comprehensive income route and to stick instead with the balance sheet route. Some respondents, was noted in the paper, recommended that specific liabilities be added to the numerator because they are related to insurance activities. Others recommended deducting specific liabilities from the denominator instead because those liabilities are accounted for always at fair value through profit and loss, whether they are reported under IAS 39 or IFRS 9. In conclusion, the staff explained to the board that they believe that these two recommendations will have the same effect on the ratio. However, any adjustments, in the opinion of the staff, should be added to the numerator because they feel it is more intuitive and understandable to actually refine and improve the numerator rather than touching the denominator, which they believe should stay anchored to the simple reference of total liabilities reported in the balance sheet of the entity. The staff paper also observed that many respondents said that issuing investment contracts should be considered an insurance activity, even if they do not transfer significant insurance risk or embed a discretionary participating features. These two things would put them in the scope of IFRS 4. In some cases, they are just another way of selling similar products that insurance entities would undertake, and the particular success that one reporting entity may have had in selling those products should not undermine the conclusion that it is still a predominantly insurance active entity. And so these should be perhaps looked more favorably in terms of inclusion in the ratio. One way of sorting out investment contracts from other non-derivative financial liabilities, which perhaps would be unrelated to insurance contracts, would be the reference to the fair value measurement in the balance sheet of insurers. And if that is the case, the staff concluded they would probably capture the vast majority of relevant financial liabilities in the balance sheet of insurance companies. And the one that will be excluded in terms of investment contracts at amortized cost was concluded to be a very small minority. On top of that discussion on the investment contracts, the paper assessed the fact that there are also other liabilities which could be considered to be connected to insurance activities and therefore could be eligible for being added to the numerator of the ratio. Examples would include those financial liabilities that are capital instruments under some solvency requirements. Given that the solvency requirements may arise from the solvency requirements in the insurance regulations, it is to issue insurance contracts that those liabilities will be originated in the first place and raise capital that will support the origination activity. Another example would be the post-employment liabilities for employees that work in the business processes that support, that make up the insurance activities. So again, those salaries are related to insurance activities and should be taken into account. Also, the profit from those insurance activities, as it generates tax liabilities, one could argue would generate a liability that even if it is in the scope of another standard, IAS 12, would still be related to the insurance activities. Another one would be the the presence of financial liabilities arising from written put options on non-controlling interests in consolidated insurance funds. Imagine that there is a mutual fund that is controlled but only partially owned by a life insurance subsidiary, and the remaining minority of that fund is sold to third-party investors of the group. The fund will be consolidated. The assets will be included line by line in the total of the financial assets of the group. But then there will be a financial liability representing the putable instruments that the fund will have been issuing to those investors outside the perimeter of the consolidation of the group. And those liabilities are often reported for value to P&L, and they definitely relate to the insurance business. Another example in the staff paper was derivatives that may be purchased to economically hedge some risks arising from insurance contract liabilities, but they are not hedge accounted under either IAS 39 or IFRS 9. And so in that instance, they could also be argued to be related to the insurance activities and eligible for consideration in the numerator of the predominance ratio. Obviously, the ISB staff analysis noted that it is important to provide sufficient guidance on how this ratio is calculated, because that would be the key point to determining whether or not an entity qualifies for the deferral of IFRS 9. And so they also analyze that if those items will be taken into account and expanded in terms of inclusion of the numerator, there should be a revision on the threshold. And what they are suggesting here, if the board takes that into account, is to expand the safe harbor levels from more than 75% ratio to a more than 90% ratio. But then to create another, if you like, interval of outcomes from the ratio calculation, which is the ratio being between 90% or more than 80%. In that area, about 10%, you would need to confirm that the predominant activities are not carried out in the reporting entity without the remaining 20% effectively being associated with another unrelated significant activity of the reporting entity. My interpretation is that if the 20% is entirely related to a banking activity, then potentially that could be a case where this ratio being lower than 90% but higher than 80% may not be sufficient to qualify. More guidance would potentially be presented in the final text of the standard when it is published later on. But this is an interpretation that I'm happy to share with you. The other point is that when you are requiring an entity to consider qualitative and or quantitative factors, then these could provide an appropriate assessment as to whether an entity is considered to be comparable to its peers in the market in which it operates. And finally, the staff paper analyzed the point that in order to meet this predominance criterion, an entity must not have non-insurance related residual activity that is considered significant, using both quantitative or qualitative factors as evidence. Evidence which we'll see later on will also feed into disclosure requirement. So having explained all that, the recommendation from the staff was that you will be permitted to defer IFRS 9 only if you have not applied it in prior years, other than for the own credit risk requirements, which applies only to financial liabilities in isolation, as permitted by IFRS 9, and the activities of the entity are predominantly related to insurance, which would comprise issuing IFRS 4 insurance contracts and financial instruments with discretionary participating features, as well as issuing investment contracts that are measured at fair value to P&L under IAS 39. These two should be compared to the total liabilities together with other liabilities that are connected to those activities, and to provide examples for those activities in the final text of the amendment to IFRS 4. That will generate the total numerator, against which the denominator would be the total carrying amount of the liabilities in the balance sheet of the entity. This ratio would allow the deferral only if the predominance ratio is greater than 90%, or if it is greater than 80% but less or equal to 90%, that the entity can provide evidence that it does not have a significant activity that is unrelated to insurance arising from the remaining up to 20% liabilities in its balance sheet. The discussion of the board started by a number of board members stating that they understand the practicality that this recommendation provides, and the need that this is satisfying, but they are going to approve it only through gritted teeth, and particularly because of the introduction of bright lines of 80 and 90%. But eventually, having made all this qualification on their vote, as you can see at the bottom of the slide, the vote was, again, very large majority in favor, 12 against 1. There were some questions about whether this 10% range between the 80 and 90% would effectively call for a reliance on judgment, and the staff confirmed that that was their intention. Some board members observed that segmented disclosure will also be another source of evidence to prove that there is no significant activity unrelated to insurance arising from the remaining 20% of the liabilities on the balance sheet. There were some concerns about the length of the list of examples that the staff put in the paper, and some comments were made during the debate as to whether this was effectively the real appropriate direction for the standard to go. We didn't observe any immediate request for revision, so at this stage we should just assume that this list will be carried forward, at least in the balloting stage, and then we'll see whether the list eventually will be a shorter one. But at this stage we have no indication of the contrary to the list that is visible in the staff paper, and that I summarized for you in the previous slide. The staff then moved on to the date of assessing these particular criteria, and here again we have a change from the exposure draft. If you remember, the exposure draft talked about a prospective change, effectively anchoring it on the 1st of January 2018. The analysis of the staff pointed out that that creates uncertainty. So you need to wait until that point in time to know whether for sure you're going to defer or not. You may make an estimate, you may be comfortable with that estimate, but it's still an estimate, and things may go in a different direction. So the point is it useful for investors to have this level of uncertainty, and does this help preparers to actually organize themselves against the requirements of implementation of IFRS 9? There is a trade-off here, because on one side the use of most up-to-date information is clearly a very important benefit, but waiting period could be too long, and that creates an uncertainty that may not be practically useful for the orderly functioning of capital markets. So the recommended changes that the analysis appears to suggest is that the predominance ratio could be calculated by using past information, as long as it is close enough to the publication of the amendment to IFRS 4. So that could be something that the staff may recommend. If that is the direction, then one final problem remains, and that is what if there was a lot of market fluctuation in that period, which may distort the outcome in that particular period only. But in all other periods, you would have passed that test, and you would be qualified to defer IFRS 9. Is that correct to penalize the entity that, because of market fluctuation, actually misses out the criteria under the revised ratio? With that analysis being set out in the working papers, the staff recommended that there should be an assessment done on the year-end that is within the 12-month period ended 31st of March 2016. Within that period, then there should be an outcome, and if the outcome is within the three buckets of possible ratios, less than 80% or 80%, no deferral approach possible. 80 to 90, a qualified deferral possible if you can demonstrate that what is left outside the insurance activity is not a significant activity, and safe harbor of more than 90%. If you have effectively fallen within the below 80%, and so you fail to pass, then you have this proposal to analyze the market fluctuations and to prove that if the last three prior year ends will actually give you on average a pass rate ratio, then you can still call for the deferral approach being met even within that failed test within the 12 months from the 1st of April 2015 to the 31st of March 2016. When the board analyzed these, the first observation was saying, hold on a second, what if the fluctuations actually produce the opposite? And the average of the last 3 years would have always failed the passage of the criteria, but the market fluctuation actually delivered that for one time only in that famous 12-month period. Is that going to be good? Another point that was made during the debate is what about auditors actually requiring a lot of analysis on the effect of the market fluctuations? Clearly that would require some significantly clear drafting for the requirements of this second test. Then it may be preferable to require the calculation of the predominance ratio just being done in the first instance by averaging the last three year ends using the carrying amount. When that was put forward by one board member, the staff countered that that would introduce a far too great reliance on historical information, which they felt would be less relevant for the outcome of the test. So at that stage, the board then concluded that they like the idea of a focus on the recent past to give greater certainty to the deferral option to the relevant entities, but they don't like to have this second chance to pass the predominance criterion. They felt that the presence of the 10% cushion between 80 and 90% was already sufficient to give a second chance to many entities, and so that unless market fluctuations condition was deleted at the end of the debate. So subject to that amendment, 12 board members voted in favor of the staff recommendation and 1 board member against. Then the staff moved into the related disclosures, and here the staff confirmed that the proposals in the exposure draft should mainly be retained, given that they provide some critical information as to what the impact of IFRS 9 will be when it is not applied. The staff also recommended that there should be some explanation of which other liabilities are included in the numerator, the revised numerator of the predominance ratio, and also other information should be disclosed to explain that eligibility in the cushion that goes between 80 and 90% ratio. So the recommendation then confirmed all the exposure draft disclosures in terms of the temporary exemption being applied to the entity, how it was concluded that it was eligible for the deferral approach, and in addition to provide disclosure around the liabilities that will actually go into numerator of the predominance ratio, as well as any information, when applicable, to the confirmation that predominance exists, but the ratio is below 90% or equal to 90%, but higher than 80%. The staff recommendation were debated, and here the board noted that the extent of disclosure that would be required about the published standard when this is released later in the year would be one that is particularly interesting vis-à-vis the IS 8 requirements of IFRSs which are published but not yet effective. that goes under paragraphs 30 and 31 of IS 8. The staff responded that in that regard, they believe that for 2016 year ends, so this annual report, companies will already have to disclose whether under this standard they will be effectively over the 90%, within the 80 and 90%, and if that is the case, what are the conclusions? So they would anticipate, and this is quite an important message from a preparer perspective and also from an auditor perspective, they would expect that under IS 8, this will be the disclosure to be published in the financial statements that will be released when IFRS 4 amendment is published. With that explanation, the recommendation was approved again with a large majority of 12 members in favor and 1 against. Then the staff continued on their presentation of other topics and disclosures on the deferral approach was next across a number of areas. The first one was the fair value for financial assets that do not meet the cash flow characteristics test or SPPI test. And here the staff analysis was that disclosures in the exposure draft would promote comparability between entities that apply the deferral and entities that apply IFRS 9 because the fair value of financial assets that do not pass the cash flow characteristics would enable the readers to understand what the possible impact of credit risk will be on those assets, and in general, the fair value disclosures on all the other assets that pass the cash flow characteristics will still remain useful references for investors. Then, on the credit risk exposure for financial assets that pass the cash flow characteristics or SPPI test, the staff analysis would argue that the feedback from users is important to be taken into account, and the feedback said that these disclosures about credit quality are very important because a number of assets measured under IAS 39 incurred loss model would have an important investor relations value, information value that would be very critical to have the disclosure for, particularly when the credit quality is low. And finally, they observe that if there is IFRS 9 disclosure in a subsidiary within a particular group that passes the predominance criteria and elects to defer IFRS 9, it would be good for that disclosure to be quoted in the financial statements of the group, even if the group does not apply IFRS 9, because investors would probably appreciate knowing that there are some parts of the group with IFRS 9 already implemented and information from those subsidiaries is available in the group accounts. The recommendation, given that analysis, is to require the disclosure that apply the deferral of IFRS 9 to be confirmed as proposed in the exposure draft, subject to 2 changes. The first one is that the fair value disclosure and the fair value changes should be separated for those financial assets that do not pass the cash flow characteristics test, the SPPI, so not SPPI. And the fair value disclosure should be then also maintained but separate from all the other assets that pass the SPPI test. In addition, there should be new disclosures. The first one is the one that presents fair value information with a sufficiently granular level of detail. So it's a granularity requirements that is going to be introduced in order for the nature and characteristics of the financial assets to be understood by the investors. The second new disclosure is that financial assets that do not have a low credit risk disclose their fair value and the gross carrying amount in accordance with IAS 39, so before any impairment allowances. And the third one is that the reference to any IFRS 9 disclosure in the subsidiary is brought up into group financial statements if the group defers IFRS 9. The debate on this body of recommendation raised a few points. The first one was taken by the staff in response to a direct question from one board member, and they stated that IFRS 7 is the basis for the disclosure. So that is the starting point, and the interaction is effectively to disclose how credit risk might affect the gross carrying amount of financial assets in order for investors to understand that dimension absent the application of IFRS 9. There is clearly difficulty to disclose credit risk information if IFRS 9 is deferred, but the disclosure of fair value of those financial assets disaggregated in the way that the staff recommended should give some very powerful indicators of potential credit losses on an expected basis. Also, they need to refer to any IFRS 9 information in the subsidiaries in the financial statements was debated. Clearly, the reference to publicly available information was an important condition, which the board appreciated. But there was some question as to the situation when the subsidiary may publish its financial statements after the consolidated financial statements of the subsidiary have been issued. The staff explained that some users can find this information helpful. It can be directed much more effectively if it is in a consolidated financial statements footnote rather than just left to the detective ability of investors. And at the end, a cross-reference will be sufficient to provide the investors with all they need to know that IFRS 9 information is there and it can be found on a particular document. With all those explanations and the benefit of the debate, the vote was again a large majority, but this was the only case where the votes against the recommendation were 2 rather than 1, and so 11 board members were in favor. So then, if I come to the next steps, I have to say that it's my pleasure to report that the ISB remains very much on track on this project, and we have now only the technical issues that were planned to be debated in May, which I would like to remind you of. The first one is the choice of the fixed expiry date for the deferral approach. The second is whether there should be a requirement for the reassessment of the conditions that allows the deferral approach to be adopted under certain conditions. Corporate restructuring was one condition that would have been proposed in the exposure draft. We'll see whether that will be retained. There will be a discussion as to whether there should be also an expiry date for the overlay approach. At the moment it is open-ended. It will only expire when the IFRS 4 Phase 2 standard is mandatorily effective. We'll see whether they want to put a finite life also for the overlay approach or not. There should be a debate as to whether first-time adopters should be prohibited from applying either the overlay approach or the deferral approach, or both. Whether an exemption should be provided in terms of diversity of accounting policies if the equity accounting method relies on accounting policy different from the accounting policy chosen by the investor reporting entity when the associate, for example, defers IFRS 9 and the investor doesn't, or vice versa. Whether that diversity of accounting policy should be maintained in the financial statements of the investor or should be eliminated. Given the fact that the Deloitte position was predicated in taking a pragmatic approach on diversity of accounting policy, I'm quite interested in seeing what the ISB decides on this particular point, and whether they are going to be more lenient when it is an equity accounting policy difference to the other one that we argued should also be seen in a more benign way. The final point is whether there should be additional disclosures related to the issues that are set out in the first 2 bullet points on the list on this slide. With the board meeting in May expected to deliver outcomes on all these points, then the plan continues with the balloting phase, fairly short and sweet, 3 months only, and publication in September 2016 for the final text. So that is all I have for you today on the webcast, and I'm going to take you all on the final slide of our webcast and invite Nikki to stop the recording for questions.